All right, let me paint you a picture. Imagine you own a company that sells umbrellas, and right now it is absolutely pouring outside. I mean, a total monsoon. You are selling umbrellas so fast you're literally hiring people on the spot just to handle the crowds. By every single real-world measure, your business is a massive success. But then you glance at your company's stock price, and it's in a free fall. How on earth is that possible?
And that right there is the central mystery we're going to unravel today. There's this huge and honestly growing disconnect between the real economy, actually making things and selling services, and the financial markets, which, let's be honest, have started to look a lot more like a giant casino with its own set of bizarre, topsy-turvy rules. So let's dig in and figure out why this is happening.
To really get our heads around this, there's a fantastic metaphor that explains it all perfectly. The idea that in today's economy, the tail is now wagging the dog. This one concept really frames the entire problem we're about to explore.
So here's the concept, and it's pretty simple. The dog, that's the real economy. It's the jobs, the factories, the products and services we all use every day. The tail, that's the financial market, all the stock prices, the trading, the speculation. Now, in a healthy world, the dog wags the tail. A company does well, creates value, so its stock price goes up. Simple, right? But what's happening now is the complete opposite. The tail has gotten so big, so heavy, that it's violently shaking the dog, and that's causing some serious real-world damage.
So how in the world did the tail get so powerful? Well, it all starts with this one crucial term, speculative ability. See, the market's focus has completely shifted. It's not really about a company's long-term health or how profitable it is anymore. No, it's about a stock's ability to just bounce up and down, to be volatile. And why? Because that's where the short-term money is made. On the swings, not on the steady, boring old growth.
And look, this isn't just some abstract theory. Get ready for this number. One analysis found that short-term traders, the people betting on all that volatility, were making 7 times more in returns than the long-term investors who are betting on the actual health of a company. 7 times. When you see a number like that, you realize the whole incentive system is just broken.
Okay, so if the market is turned into a casino that rewards chaos, you have to ask, how did we even build this thing? What are the actual mechanics that got us here? Let's go under the hood and look at the structural forces that are completely overwhelming the market.
It really boils down to this perfect storm of 3 incredibly powerful forces. We've got a massive wall of money, a shrinking pool of places to actually put that money, and then the final piece, the rise of the robots. Let's break down each one.
First, just try to comprehend the sheer volume of cash we're talking about. Every single year, almost $2 trillion of new money just floods into the market. And a huge chunk of this isn't from some genius investor picking the next big thing. Nope, it's our money, our 401ks, our pension funds, just automatically pouring into index funds. It's passive, blind money that just buys everything, pushing prices up no matter how well a company is actually doing.
Now here's where it gets really nuts. At the exact same time that this wall of money is getting bigger and bigger, the number of places to actually invest it is shrinking. Thanks to mergers, buyouts, and just fewer companies going public, the number of listed companies has dropped like a rock. So you've got way more money chasing way fewer stocks. It's creating this insane market pressure cooker that just warps valuations and fuels even more volatility.
And this brings us to the robots. Think about what happens when the market starts to panic. 95% of us, the people saving for retirement, we're just holding on for dear life. But our opinion doesn't matter. The price isn't set by us. It's being set by the tiny 5% of active, high-frequency traders and their automated algorithms. It's like we're all in a crowded movie theater, and 5 people suddenly scream fire and sprint for the exit. Their panic decides the fate of all 95 of us, even if there was never a fire to begin with.
You know, this isn't just a numbers game on a screen. All of this chaos, this violent shaking of the tail, it causes real, tangible harm to the dog, to our actual economy, to real people. So let's talk about how this financial mess translates into actual pain.
This quote from Dr. Senthil Kumar just absolutely nails it. A person's value, their skills, their contributions, those things don't change from millisecond to millisecond. A company's real potential for innovation doesn't just evaporate overnight. And yet, we've built a system that lets a hyper-volatile market decide their worth on a daily, even hourly basis. It forces us to constantly fight to protect the real intrinsic worth of both people and property against this crazy tide.
And the consequences are severe. When a perfectly good company's stock price tanks for no good reason, the boardroom panics. They slash costs, and that means layoffs, lost jobs. They kill their research and development budgets, which means they stop inventing the future. It shakes everyone's confidence, consumers, investors, and that hurts economic growth for everybody. And this damage can be permanent. Just look at a giant like General Electric after the 2008 crisis. A market panic can permanently cripple even a fundamentally healthy company.
Okay, that all sounds pretty bleak, I know. But here's the good news. This isn't an unsolvable problem. There are smart ideas out there. So the question becomes, how do we get the dog back in control of its own tail? Let's explore a few ways we might bring some sanity back to the system.
So on a big systemic level, what if we just introduced a little bit of friction? Instead of just slamming the brakes and halting all trading, which can actually make people panic more, we could use a smarter system. Think of it like putting turnstiles at the exit of that burning movie theater instead of just locking the doors. It's a system that slows the stampede. By putting sales into an orderly queue, like first in, first out, you prevent that instantaneous meltdown, and you force the market to actually breathe and find a real price instead of just reacting to panic.
And you know, companies don't have to just sit around and wait for the rules to change. They can act on their own. Instead of being a giant monolithic shark, where one big failure can sink the entire ship, they can adopt a school of fish strategy. This means breaking themselves up into a network of smaller, more nimble units. Google's restructuring into Alphabet is the perfect example of this. If one of those smaller fish fails, it doesn't take the whole school down with it. It's about building resilience from the inside out.
But there's one last idea to chew on, and it's much, much bigger than all the others. Maybe the problem isn't just that the casino is rigged. Maybe the casino itself is just too small for the world we live in. That entire $75 trillion global economy, it's really hyper-focused on serving only about 3 billion people, while the other 4 or 5 billion people on this planet are still largely left out.
And that leaves us with a final, really provocative question. What if the real solution isn't just about tweaking the rules of the financial casino? What if it's about making the dog, the real economy, so big, so vibrant, and so strong that the casino becomes nothing more than an irrelevant sideshow? Instead of fighting over speculative scraps, we could be building real, tangible growth by bringing the rest of the world into the fold. Now that is something to think about.